Welcome to the South Florida Mortgage Report from beautiful South Florida. It's your non-hat dude, but hoodie-wearing guy, Billy May, mortgage guy, with Craig A. Garcia, president of Capital Partners Mortgage. Craig, good morning. How are you?
Good morning, Coach Belichick. How
Yeah,
are
yeah,
you?
yeah. I'm wearing this in honor of, Super Bowl week, of course, and the coaches won the most Super Bowls. Somehow got snubbed by the Football Hall of Fame. Of course, we down here in South Florida are not really a big fan of him anyway. So,
Yeah, but you don't want to see somebody so clearly deserving not get in. I mean, so I guess it's a
well,
penalty for his cheating transgressions, is what I understand. But
I heard that, but also I didn't realize this is, I read this online as well, is that they changed the criteria. They moved it up to like 2 years. It used to be 5 years. Don Shula had to wait 5 years. Among other coaches, used to have to wait 5 years. They changed the criteria to 2 years recently.
I didn't realize that.
Yes.
Got it.
So
Interesting.
the reason why they didn't let him in 2 years. So, but that's a whole other story. We're here to talk about mortgages in South Florida. It's a beautiful day outside and 45 degrees out. I got my hoodie on and ready for a great. What do we got this morning, Craig? I know the mortgage index, the rate come out, and rates are probably I don't know, hovering about the same thing, 6.25. Nothing dramatic. We didn't get the non-farm payroll report today. We're gonna get it next Friday because of the temporary government shutdown, I guess.
Yep.
But let's talk. But you got a great topic to talk about.
Yeah. So there's certainly it's a pain point for people. It's a nationwide discussion. It's certainly a talking point in our market too, which is affordability. I always like to see what are people searching for online, and one of the big ones is how much house can I afford, and so how much house can somebody afford, and so there's two things, and I think there's a couple ways of looking at it. And so so I thought I'd talk about a couple of the kind of the benchmarks that people usually refer to. One of them is 30% of your gross monthly income should go towards your house, right?
Yes.
Which is something you could commonly hear. And then, and I've also heard, hey, 25 to 35% of your of your take home payment,
Yeah,
which
these are things historically we've read over the years that have kind of been the default, but those numbers have been in line for a long time. So, I mean, are they still relevant? I mean, I'm kind of curious.
It's interesting. I mean, I think that it's great to have a kind of a benchmark and be able to use that. But I definitely feel like, some of that is, um, you know, probably not as ideal for most people as you would typically think. So,
Yeah.
so I said, you know what? Yeah, especially down here. I mean, so I did pull some numbers, and so I pulled all the transactions that we closed last year, and I looked at the total debt to income ratio. So this is not just the house. So usually a lender will say, hey, the real benchmark is, hey, front end ratio, which is the house, your house, maybe 36 or 33% to 43, 45% is kind of like your generic, the 43, 45 would be for your total DTI. So that would be the house plus any other debts that you have.
That should go up on the credit report. That's always key now. Remember, because I've had people, they try to tell me, well, I've got this, my this insurance, I've got my cell phone bill, I've got my internet and everything. It's the items that report to the credit bureau, basically.
Well, that's correct, and any other obligation that they have that maybe not on a credit report, child support,
right? That's true.
alimony,
That's right.
a private loan that's not on the credit report, but you're actually paying. But so it's really anything that you borrow that you have to pay back or that you're obligated to pay. That's not, like you said, insurance, food,
Right.
electric, that type of stuff is not considered in this total ratio.
Right.
So I thought it would be interesting, Bill, to kind of, see what you think is versus what the reality was of what percentage of the people that we lent to last year fall into some buckets in terms of their total DTI.
Yeah.
So this is not the house payment, but so out of everybody that we closed last year, Bill, what would you say if I said, hey, the percentage of people that with their house payment and all of their other obligations are under 30% of their gross monthly income? What would you think that number would look like?
I would think that total number would be under 15%.
You are pretty good because it is basically 15.5%
Really?
of everybody that we closed last year that had a total debt to income ratio under 30%. It's about 15, 16%. So
Wow.
then the next bucket would be 30 to 40%, right? So what
Right.
percentage of customers do you think between their house payment and all their other obligations was 30 to 40% of their gross monthly income?
I would say about 30% of our customers had that income ratio total.
So this one, it's a little lower, but you're close. So it's about 24%.
I was going to say 25 too. I'm like, you know what, man?
I saw you about to say it. I thought you were about to say it. I'm like, man, you're really good at this.
Yeah.
So about a quarter of everybody is, 30 to 40% of your gross monthly income. So
Okay.
now the next bucket would be 40 to 50%. Okay.
Right.
Of gross monthly income that would incorporate their house and all their other debts. What do you think that percentage is?
I'm going to go 45%.
You're close. You're a little low. So it's about 51%.
51. Okay.
So
All right.
about
That makes about
51%.
okay. That makes about sense because I'm kind of
Yeah.
thinking what the remit, what's left of us doing loans of people over 50% debt income, which would be about what, 9%?
That's about right. Yeah. That's it. That's the number. So it's a 9%. So a little under 10% of people actually getting a DTI over 50%, right? So more than 50% of their gross monthly income is incorporates everything. There's one interesting thing about that. That's basically that's going to be one of two different kind of loans that we're probably doing for those people. That's either going to be one of those loans, Bill.
Yeah, VA or FHA. So
that's it. Those are really, you can't really get a conventional loan. A conforming conventional loan, which is like a regular Fannie Mae, Freddie Mac loan, that would be there. So so if you look at this, so now we just basically said about 60% of people are over what we just, now this is not exactly comparable to the number that we just said about how much house can you afford, but it does show that, that on a gross monthly income, that people are, and with all their debts and everything, then, that there's a good amount of people that are in this, higher end range versus their gross monthly income. And some people might be wondering, well, why would you lend to somebody with more than 50%, right? Now,
right.
keep in mind that everything that's allowed, it is allowed because there's a good track record of not defaulting, for these types of borrowers, and the way that we underwrite loans, and the way that the industry underwrite loans, even these over 50%, there's a good enough track record of people making these payments using this underwriting methods. Which, that's why they do it. They're not taking speculative risks on these. There's percentages and there's track record of repayment. But the other thing I think is interesting is, the way that lenders do it. Some of these people, even though we're looking at this percentage of their gross monthly income, some of these borrowers may have their take home versus what we're looking at might actually better than what we'd be giving them credit for.
That's true. I mean, sometimes they have, side jobs. If you have a second job, we have to have a 2-year history. I know people that bought homes and they're going to take in a roommate. I mean, they're going to have we can't look at that.
Yeah, and then anybody who's self-employed. Usually, you part of the benefit of being self-employed is you can write off certain parts of your lifestyle, maybe through your business. So your gross monthly income that we would look at on your tax returns, versus how much you're actually benefiting from that business, we're probably underestimating what your income is.
Great point.
And so those people are probably going to have a higher DTI. And so I think that's interesting. But like you said, they have a second job, without the proper history. We might not give them credit, but they're making that's income that's really coming into their house. They may not have enough history, stability of bonus or overtime or other types of income, that we might not give you credit for to qualify, but they're actually earning it. So that that take home ratio is going to be a little bit stronger for them.
Yes.
And so, and then listen, sometimes, some of those borrowers where the take home is strong, but what we would be able to use isn't good enough even to qualify for what they'd like to do. That's when we get into these alternative loan programs, bank statements, and things of that nature.
Sure.
So anyway, I thought that was pretty interesting.
Yeah,
And then,
I'm not surprised by those results. I mean, in South Florida, it's a high cost area. We know that, and it seems like most of the borrowers, and I think what it was, 60%, Craig, were below 50% or 45%. I think it was, right. I mean, when you look at it together, but there's that big window there, right in there. It seems like most people that I do loans for are usually in that the debt to income ratio, the back end, that 40 to 50 range. That's what it seems like to me. A lot of them.
yeah. And I thought this would be, a good time to talk about, well, one of the reasons why this, people would do this, right? Because, some people, it's like, hey, listen, it's cheaper to rent. It might be cheaper to rent right now than it is to own, right?
Yes.
And obviously the panacea is when you can find a situation where it's cheaper to own than rent. And all things considered, I think you could make a case, but what you're outlaying today, more than likely is going to be on a monthly basis, it's going to be more expensive today. You're going to outlay more to own than to rent a comparable property. Would be my speculation.
Yeah, there are reports and statistics that state that. When you look at it just kind of right now, what if you're looking at bang for the buck right now, but we're going to look at the long term stuff. That's really what you want to look at.
Yeah. So the question. So why would you do it, right? So and then I wanted to kind of do a screen share here for a second because I got a couple of. I like going to the St. Louis Fed. They have a lot of really cool data sets and charts that you can see. And so let me just pull one up here. So this is, we talk about inflation a lot because inflation affects rates. It's funny. This is inflation going back, before 1965. And at first glance, you go, oh, okay, yeah, inflation was a problem, before the 80s. And then, then it's been pretty good, but then it's become more of a problem recently. But when I look at this chart, what I notice is, and this black line right here, this is zero, right? This horizontal black line going right over here, it's a zero. Out of all of those years, the only time it was a negative number was during the great financial crisis, right? So what does that mean? That means that stuff is always getting more expensive. Inflation increases the cost of stuff, right? Whether it's the stuff that you need to buy to live, what it costs to buy a house, what it costs to rent, right? So everything's always getting more expensive over time. Even when inflation is tame, things are still getting more expensive.
Yeah.
So this is, so one of the reasons people would say, and if somebody's thinking, hey, listen, I could buy right now, but I don't want to be uncomfortable. Well, it's the longer term view. Real estate, we always say it's not a day trading situation. This is, real estate's a long term thing.
Yeah.
You got to pay to live somewhere, right? So now, if I say, hey, this is a different chart. This is rent over time. And you can see it goes from the bottom left to the top right. I mean, so over time, over the long haul, rent is going to keep getting more expensive. Whatever you're going to be able to pay in rent today, you're going to be paying more in the future. You know what I mean? So it's very rare that rents come down. They certainly don't go down over time.
Right.
And then the other thing is, so, hey, this is where, so inflation is going to increase what it costs you to buy stuff. You know what I mean? What it costs you to live.
That's right.
This is rent. Hey, this is what it's going to cost you to rent over time. It's going to get more expensive. But inflation does help in some ways too. And one of those is this is personal income, right? So, like I said, everything gets more expensive all the time. For employers, it costs more money to employ people. If you're an employee though, hey, over time you make more money, right?
Yes.
So one of the things that when you own that is working for you is if you were to buy a property today and you got a $400,000 loan at 6% or 6.25% or whatever, right? In the future, that on a 30-year fixed rate loan, that is not going to change.
Yeah.
Right? Everything's getting more expensive except for that piece of your homeownership obligation.
Right. I mean, the principal interest of your payment, obviously, the taxes can vary slightly, but, we're in a homesteaded state in Florida. That's not going to go up much. Insurance could go up slightly. HOA costs could go up slightly, but generally speaking, we're not talking huge increases here. So,
right. So, but listen, to me, if we just keep it simple, hey, look, your taxes are going to be more expensive. Your insurance is going to be more expensive. You're going to make more money. You know what I mean? And then you're, and everything else is going to get more expensive except for that loan. That payment's fixed. So when you talk to somebody who has owned a property for 20 years and you look at what they might be paying if they've had the mortgage for that long, you know what I mean? Now, keep in mind, if one of these once in a lifetime opportunities comes around, where suddenly rates go down and you actually could refinance it, you could actually, that payment could go down if you had a refinance opportunity that made sense. It could get cheaper, but it's not going to get more expensive. Meanwhile, so that's why there is this line of thought, and I think we'll do a whole other thing one day on the case that can be made for borrowing as much as possible for as long as possible. It would be because of this phenomenon, right?
Yeah. Yeah.
You're going to make more money, now, again, you're not going to make more money if you're about to retire, right? And now you're not going to work anymore. But in general, wage earners make more money over time. And so that is, even if it might be more expensive today to own versus renting, if you started doing that now, you're going to be in a better position moving forward. Because then the other thing is the inflation now will be working on the value of the property, the asset that you own. So the debt that you use to buy the property is not going to go up on a payment basis, but the value of the asset is going to go up over time. And these things are part of the reason why, the average homeowner has a net worth 10 times that of the average renter.
Oh yeah, no, absolutely. And especially down here, we keep talking about that, Craig, in South Florida. The valuations, they just keep going up. We don't have any new construction. There's no competition here. And like you said, when you retire, you're going to have an asset with more equity. That's going to be your long-term wealth. This is the biggest part of your life that you're going to be paying. So why? Because the rent, if you paid rent for 30, 40 years, you know that rent's going to go up because you've got the chart there. I mean, it's really it's a no-brainer. And really, to buy something when you're as young as possible to buy the home, this just shows you right now. Because, if you're 25 years old, you buy a home, yes, it might struggle a little bit in the beginning, but you're going to make more money historically. The inflation's going to continue to go up, and you're going to be locked in at a very affordable payment.
That's the idea. That payment should get more affordable over time.
Yeah.
As inflation happens. I mean, as we can see, inflation happens, whether it's small inflation or big inflation. It's like death and taxes, pretty much. You know? So over time, populations go up, inflation happens, and so the mortgage and the home ownership is one way that kind of it kind of insulates you from that, you know what I mean, and allows you to benefit. So anyway, I thought that was interesting. I thought the breakdown of the, what percentage of people, you know what I mean, are, at what DTI level was pretty cool.
Yeah. And we did not talk before this, you know what I mean? So, I mean, I just picked those numbers based on my experience as a loan originator, kind of what I see. And I wasn't surprised by that. And I think it was 9% over 50% debt to income ratio on FHA loans. I believe that. I'm actually kind of thought it might be slightly higher, but no, I believe that. And the data is there. I mean,
yeah. So
I think we're higher in South Florida because it's expensive, you know what I mean? So.
No, it is. Listen, there's no getting around it. It's not a cheap market to live in. I mean, people try to move to South Florida from all over the world, you know what I mean? And so that puts pressure on things. And and so if you can get in, that as long as that dynamic exists, that's gonna make it a better long-term investment if you can make it work. You know what I mean? So so I think
great stuff. No, this is great stuff. So we got to make that into a pie chart. All your data.
There we go. Maybe we can work on that. So
That's
I'll get
cool.
AI on that. So,
Yeah, there you go.
have you done one of the AI caricatures?
No, everybody's doing them. I haven't done one yet, though. I'm kind of. I guess I should, huh?
Should you or not? I don't know. I did do one that was kind of fun. Because somebody asked me, they sent me a picture of a realtor who had a picture of themselves with their little dog, right? And so,
Okay.
and some agents, some people like to do that. And
Sure.
I said, I don't know if I could do that. I said, unless I had, unless I was like something cool looking, like I had some, hellhound and I could wear a cape. You know what I mean? I said, maybe I would do it then. And I said, I wonder what that would look like. So I put it into Chat GPT, and sure enough, it pulled up something, and it was pretty cool looking. So
Yeah, I like to see that. Now,
anyway,
is everybody doing their own Chat GBT, or do I see everything on social media? Is there like another app that people just go into that?
I have not tried it yet, so I don't know. But it's definitely getting a lot of run. So
Yes,
maybe we'll check that out next week or something.
all right,
So,
that's good. That's
but
awesome, man. Actually,
yeah. So anything else for the week?
no, that's about it. It's just getting ready for the weekend. Enjoy this beautiful weather here in South Florida. I guess I will watch the games that game on Sunday, Super Bowl game. I don't know, Craig. You got a prediction? What do you think?
I think the Seahawks kind of hammer them. That'd be my
Really?
prediction.
All
Yeah,
right.
yeah. I think they've got a pretty good all around team.
Uh-huh.
Yeah. I mean, it's pretty interesting Super Bowl matchup. Unexpected, I would
Yeah, I was
say.
gonna say, I think the Las Vegas people at the beginning of the year, they didn't pick this. I'm gonna go with the Patriots, actually. So
Yeah, and I honestly can't figure out who I would like to see win. You know what I mean? I don't really have any love loss for either of these teams,
no,
but I do hope it's an exciting game. That would be fun.
yeah, I was exciting game. For some reason, I think the Patriots will win. I don't know why, but whatever. We'll see what happens. So
The only person I like in the whole thing, I actually kind of like Darnold, but I do like
yeah.
Vrabel.
Oh yeah.
Yeah.
Well, I wish we had him as a coach down here.
Oh yeah, for sure. So,
Yes.
all right, sir. Well, enjoy the game and have a good weekend. Try to stay
Thank you.
warm.
All right. You stay warm as well. I'm gonna build a fire tonight, as a matter of fact.
Good idea. All right, Bill. See ya.
Thanks, man.